following is a presentation of TFNN. Trade what you see with Larry Pesavento. Call now, toll free at 1-877-927-6648 or internationally at 727-873-7618. Now, Larry Pesavento.
Okay, looking good, Billy Ray. Feeling good, Lewis. We're going to start the show like we usually do. We're going to take a look at the German DAX. As you can see, we've had a nice little ABCD pattern. That's not the German DAX, that's the FTSE. Whoa, what a good way to start the show. Not so much. Anyway, we'll take a look at the FTSE. You'll see it's had a nice little ABCD, started to sell off from there. But the important thing is the fact that, we had this day yesterday that we talked about. Those of you that get the 24/7 newsletter, notice that I spent a great deal of time going over all of those fib points that were hit in all of the major indices, the FANG stocks, gold, silver, and some of the others. I mean, it's just an incredible cycle bottom that was here, folks, of some kind. And of course, we had the largest single update we've ever had in stocks, with the Dow up 1290, and then it continued another 300 points higher than that overnight. We went a little above the 38% level in the E-mini S&P. I'll post that in just a little bit, but I wanted to go over just a few things that are happening in the news. I mean, it's one of the reasons I don't watch the news or try not to pay too much attention to it is because you don't know which side you're going to get, and even if it's true or not. And the other reason is it really doesn't affect the trading because the markets respond to the news, and the news follows the markets. The market leads the news, so it's not a big deal if you want to remember it. One of the best things you can do here at TFNN is to learn some of the things that people keep preaching about, and sometimes they work and sometimes they don't. But one of the things that I've always watched, and ever since I started reading the book Reminiscence of a Stock Operator, way back in the late 50s and early 60s, and that was that Jesse Livermore was an expert tape reader. He liked to see, the buying and selling that was going on, and he always said that the sum total of those charts is all the buying and selling that goes on, so you can't really do that. Now, let's just take humor me here for just a little bit. Now, stop and think this week that we've had the Dow down last week, and then also a little bit on Sunday night. But last week we had the Dow down 1,000 points several times. And I mean, it's tremendous negativity. There was fear everywhere in the world. And if you remember, I pointed this out to you, many, many months ago in a stock that we know as Netflix. And I just wanted to bring this up here to show you here. Let's get this up here and post it. And if you remember at this time, folks, you'll get an idea of why the market reaction and the way the market reacts to things is so very important. I want you to go back to the end of remember December back in here, where the Dow was down over 600 points that day, and Netflix was basically up on the day. Can you believe that? It's up in the day when the market was down, a lot. If you remember, that was our last major low. That was the 61% retracement of what we based the one we had on this that we had on Friday. So that's the main thing. Now, take that arrow. You can see that arrow go all the way over to the right. Here we have Netflix over there. Look, it can barely make a lower low and closes higher on Friday with the market, it was down all day except at the very end when the market turned. But I mean, this is why it's so very important. Now, when that does that, folks, when you stop and think, if that stock is that strong, why is it that that somebody knows it? We don't know the answer to that. Nobody does. But that's the real key. Now you can see. On Monday, look what happened. I mean, you can see that Netflix, it only up about $24, but it was telling you how strong it really was. Folks, I've been doing this a long time. I have never seen this many Fibonacci's hit as we did Friday, major ones, and they did it to the exact tick. That's the real thing that you're looking at here. Look at this. Fact is, the largest of all the stock indices, of course. Let's just get this up here. Is the New York Stock Exchange Index. Do you know, folks, you probably don't even know this. Do you know why they don't allow trading at the NYSE on this index? Because it's the index that they gauge on what the value of the stock market is, because this is the broadest indication of it. That's the main reason, because they want to see what the pure value is, not, speculation between a bunch of, traders, commodity traders or future traders or stuff. So that's the main thing. Now, you'll notice last night, you see that the New York Stock Exchange Index went up and almost hit an exact 382 retracement. We got a caller on the line, and he's none other than Mr. Z from Philly. John, how are you this morning?
I'll tell you, your poetry is terrific, Mr. Pesavento.
I once was a poet, but I didn't know it. Go ahead.
I love it. Hey, tell me, given everything you've just said this morning in the past 5 minutes that you started off emphasizing yesterday, given that, do you limit your trading to the buy side, only buying dips and letting go of winners on rallies and then rebuying again on dips? Do you take that tack, please?
Yes, no, and possibly. John, I am a very short-term oriented trader because I try to be as risk reverse as possible. But when I see something that happened like we saw on Friday, it is so significant that I have to have a bias there, because the market has told me with the bad news that was out there. I mean, you know how bad it was. I mean, it was just, the end of the world was in sight. We could see it from the edge of town, as O.J. Simpson used to say when he lived in Buffalo. But the main thing is that when the news is that bearish, and when the news is that bearish and the market doesn't want to go down, and we have an 8% increase in open interest in the S&P futures in one day on Friday, I mean, that is screaming to you. Now, how long is that going to last, and who did it? I don't know who did it. All I know is that it was very, someone put really, really big bucks into it. I believe that the Federal Reserve is in there trading up and down, try to help the markets. I'm sure they're in there. I know they've got several hundred traders that they employ, but the main thing is that if you follow what's happening to the news, you got to ask yourself the question: how could the market possibly do what it did on Friday, given the fact that the news was so bearish? And so all I did, John, is I went back and I, on that Saturday morning, real early, I got up and I looked at all of the main stocks that were new, those 10 big stocks in the NASDAQ. Those are the FANG stocks, the big stocks in the S&P, the big stocks in the Dow, and to see what happened. Now, all of those things acted in unison. In other words, they're all bottoming together. John, how hard it would it be to coordinate something like that? I mean, it has to be one unit has to be doing it. That's the way. Stay with us, John. We'll be right back. 877-927-6648.
If you're not currently using the TAS Profile Scanner when looking at setting up your trading opportunities, then your arsenal is short a mighty weapon. The TAS Profile Scanner is a standalone piece of software that instantly filters over 2,500 global financial markets such as stocks, ETFs, commodity futures, and Forex. Headed by Steve Dahl, TAS understands that in today's technological world, the use of top-flight software applications and technical analysis expertise is essential to successful trading in today's market. You also gain access to the webinar that Steve Dahl and Tom O'Brien just hosted, The Best Way to Use the TAS Profile Scanner to Profit. This webinar archive is available for all subscribers immediately upon signing up. All new subscriptions also come with a 30-day money-back guarantee, so you have nothing to risk. Start your subscription by visiting the front page of TFNN.com today, and you'll find the TAS Profile Scanner under the Services tab. Sign up today. Are you in the market for buying or selling real estate in the Bay Area, including the surrounding St. Petersburg, Tampa, and Clearwater markets? Tiger Real Estate LLC is a firm that has extensive experience in the Tampa Bay area. Whether you're looking to sell your current property for maximum value, or you're in the market for a second home or investment property, Tiger Realty has the experience across all areas of real estate in the Tampa Bay area to help buyers and sellers make the most informed decisions across all price levels. From the price you should be paying per square foot in certain up-and-coming areas to the type of cash flow investment properties are capable of creating, Tiger Real Estate can help you make the best decision when it comes to all areas of the market. Before you make one of the biggest decisions of your financial future, call Tiger Real Estate LLC today at 727-329-8322 or email us at tiger@tfnn.com. That's 727-329-8322. Call us today.
Many of our new listeners have heard about The Tiger's Den. The Tiger's Den is a lively community where professional traders and investors can meet, exchange ideas and information in a comfortable, moderated atmosphere. Hear all of the TFNN shows, plus see all of the charts as they happen live and have access to archives of all of those charts. You can test drive The Tiger's Den absolutely free for 30 days and greatly enrich your knowledge of these markets and how to make your money work for you. Details on The Tiger's Den are on the front page of TFNN.com.
TFNN has launched our brand new website. You can still visit us at the same TFNN.com URL, but when you do, you'll see a new and improved homepage with a much simpler navigation, whether you're watching Tiger TV live in high definition or just accessing your newsletter subscriptions. We even have new pricing in 6 months and yearly options. Check out the new TFNN.com now and experience all the upgrades. TFNN.com, educating investors.
Call now, toll free at 1-877-927-6648. Internationally at 727-873-7618.
Okay, we're back, folks. We have Mr. Z on the line, and we've been joined by Rich Anderson of Anderson Capital Management, retired recently. Rich, are you on the line?
You bet. Good morning, Larry. How are you?
Good morning. Mr. Z and I are on the line here. We have a question about what's happening in the grain markets and what do you think is happening with all of this volatility that we're seeing, buddy? And tell us about your experience in Las Vegas. That was very interesting. So go ahead, my friend.
All right. Well, first of all, in the grain markets, you know, everybody's kind of just tagging along with the equities. And then, you know, the equities had the rally yesterday. The short covering that starts there, you know, the short covering starts in the grain markets. However, when you look a little closer, you know, many people look, but they don't see. You'll see that the March corn is inverted to the May. That shows you some real demand. That shows you somebody's willing to pay more for it today than 2 months from now. Somebody wants it. We still haven't seen any major purchases from China, but there's no indication that they're going to defer their agreement, their phase one agreement. That's good news, but we need to start seeing something like that. But we're just tag along to the equity markets. The equity markets, I sent to the email last night about, you know, the volatility. Like on Friday, there was a 60-handle break in the S&Ps after the rally, and then the stuff we saw yesterday. Well, volatility is very high right now, so these guys are selling options. That makes you short gamma. That means that as the market, if you sell something that's at the money and it goes in the money, it goes from 0.5 to 0.6, 0.7. Well, it increases at a faster rate. So if I'm short gamma, when the market goes down, I have to be selling more futures to be net my position out. And then when the market rallies, I have to be buying more position. And we had the volatility kind of a swing back in 2018, and that was what was happening. So that's accelerating this thing, along with the algos. You know, every time it goes to a certain point, it triggers orders, and these algos trade in the blink of an eye much faster than we can even twitch. That's what's going on.
Wow.
Good morning, Rich. Larry, may I ask Rich a question, please?
Sure, go ahead.
Rich, this is John. Rich, I wanted to ask you two questions. First, they all have to do with the new crop contracts: November beans, December corn, and July Kansas City wheat. Just full disclosure, I'm long all three of those. Started on beans a week ago Monday, and then bought into or rebought. I had tried picking lows earlier, took small losses, and rebought the Kansas City wheat and that December corn on Friday. My question, Rich, is now the time to be long these, now that they've fallen ahead of planting season, where we might get bailed out on the long side just by short covering and weather snafus that might occur? And the second question, Rich, globally, are there any threatening weather patterns setting up that could threaten crop development, planting, or development anywhere on the planet we should know about?
Well, first of all, I come on every year with Larry about this time, and the statement I make is when the farmer starts to put his money in the ground, planting, the markets are going to, catch and hold because there's that bit of uncertainty. I drove through a lot of the United States in the last couple of months, and down in the Mississippi and Alabama, they're so wet, it's unbelievable. I mean, we're talking records. A portion of Kansas is a little dry on wheat, but nothing big yet. What we do know for sure is that the weather patterns, they seem to be trending sharper one way or another all the time. The example of a worldwide place where you have to be a little concerned. Remember the fires in Australia a month or so ago? I was reading something last night, which mostly all I do is read and research, that the Australian summer is now another 31 days longer. Well, that makes it hard because that doesn't give them an opportunity to burn off the brush, and therefore they get more fires, right? And they're a major producer of wheat, but there's no areas where we're really concerned yet. But, like they always say, when you're a farmer, you're only like 5 days away from a drought.
Yeah, excellent point. I've remembered, Rich, just in the past couple of years, I hearken back to 2016, where prices were low, everything looked okay, and then all of a sudden in March and April there were record rains, flooding, and the Argentinian soybean crop took a hit, not because it didn't grow, but you couldn't harvest it. And then in 17, we had that drought that flashed up in the northern plains, and the Minneapolis wheat skyrocketed. So hence my question about getting long now, just in case there's a weather snafu sometime between now and July.
Well, that's an okay strategy if you've got a lot of money. I prefer to get long when the markets tell me to get long, but certainly this is a seasonal time when you take a look and want to be watching closely those markets. But the crop reports come out in March. Okay, the USDA estimates how many acres are going to be planted of corn and beans, and those numbers. I mean, first of all, the USDA had its ag forum in Washington D.C. back in end of February and was talking about the number of acres that they were going to plant, which is about 10 million more than last year. Of course, that's assuming it gets all in. Last year, we didn't get it in because of the moisture. I mean, we got in South Dakota maybe on our farm, 30-40% of the acres got planted because it was just too wet. But Rich, they'll have numbers coming out in March, and those numbers are probably going to rain on your parade initially.
I'll sign off.
Okay, that's great. Thanks for joining us, Mr. Z. Rich, tell us, the folks, about your experience in Las Vegas these last week or so that we were chatting about.
Well, I mean, everybody knows the coronavirus story. You see a lot of people that are working are wearing gloves. A lot of people are wearing masks. Not massive amounts, but you see it here and there. The masks only do good if the person's sick. And the problem with the coronavirus, you can be sick and contagious for 14 days before you show any symptoms. China's been able to control it. They're controlling it by social distancing, being 6 feet away from people, no more than 4 people on an elevator. But they've actually got their hands around it, but it's at a tremendous cost to their economy. There are other parts of the country now that are Korea, Iran, where that's the area we're watching most closely. It's something that a lot of people will get and maybe not even know they had it. But if you're over 60 or if you have compromised respiratory systems, it can be deadly. And it seems to be deadly in men over 60, 2.8% of the time versus women 1.7% of the time.
Wow.
We have to
Hey, Rich.
take it seriously.
Yeah. Hey, buddy, thanks for joining us. We'll have you on again soon, and be safe, my friend.
Watch your gammons. Bye-bye.
You bet. Okay, we'll be right back, folks.
Larry Pesavento has just started his brand new service, Fibonacci 24/7, and he's already delivering content to his subscribers on a daily basis when the market's opened and even on weekends. Each Monday, you'll receive Larry's written report that provides detailed commentary and a summary on the charts and videos that Larry sends out. And throughout the week, when warranted, Larry will send out via charts or videos or both the key markets that he is watching during the day. This will be up-to-the-date, active trading information that will help you in your daily trading. In Larry's first week alone, he sent out 25 charts, 6 videos, and a full report to his subscribers in just 1 week. If you're a technical trader that uses patterns and retracements to trade, then Larry's service Fibonacci 24/7 is something that you must try. Right now, new subscribers can get a full 30-day money-back guarantee. With nothing to risk, sign up now to Larry Pesavento's Fibonacci 24/7 by visiting the front page of TFNN.com under Trading Newsletters. If you're a trader in the market looking to find the path that leads to maximizing profits while decreasing risk, then now is a great time to try out Dave White's daily trading service, The Path of Least Resistance. Through the use of options and equity trades, Dave advises his subscribers on a daily basis of the current market conditions and what possible trade setups are on the horizon. The Path of Least Resistance is published every trading morning, often with updates intraday when initiating trades or closing out positions. Dave White has advised his clients of some outstanding winning options and equity trades in recent months, and now is a great time to try it out for yourself. New subscribers to the Path of Least Resistance receive a 30-day money-back guarantee. See for yourself the types of options and equity trades that are available by signing up for the Path of Least Resistance today by visiting the front page of TFNN.com and selecting the newsletter tab. Sign up today. TFNN is excited about our new software charting program, The Art of Timing the Trade Charts. In collaboration with Tom O'Brien and using his best-selling book, The Art of Timing the Trade, Your Ultimate Trading Mastery System, David White has programmed an outstanding piece of software that will complement any trader's methodology. Using this first-of-its-kind program, The Art of Timing the Trade Charts allows you to scan thousands of stocks for Fibonacci formation setups, including Gartleys, ABCs, butterflies, and much more. The Art of Timing the Trade Charts is designed to help you when scouring the markets for stocks just beginning to form the trading patterns that many investors spend days, weeks, or even months searching to find. And right now, we're offering licenses available at only $79 a month. We are so confident that you're going to love this new charting software that will even give you a 30-day unconditional money-back guarantee. Don't miss out on this incredible new piece of software. Get your copy of The Art of Timing the Trade Charts today by visiting TFNN.com.
This segment is brought to you by Think or Swim. For more information, just click the Think or Swim banner on the front page of TFNN.com.
Okay, folks, we were going to have Stan Harley on this morning. We have a few little technical difficulties at my end, so hopefully we'll get him on here in a few minutes, and if not, we'll have him later on tomorrow for sure. Tomorrow we will have Bill Chapman, and then on Thursday we're going to have Bill Meridian on, but let's just walk through here what happened yesterday in the market. Those of you that were here at TFNN as we were looking at this thing, I posted something in the morning, right at what we call the real interesting time of the day, which happens to be that 8:30. Well, it's actually 9:30 to 10:30 time frames, and that's what was, so very interesting about what the markets were doing. And let's just get up here. Hopefully, we'll have Stan on the line now. Hey, Stan's on the line. How are you doing, Mike? Good morning, my friend. I posted your first chart on the volatility index, and we've got some of that going on. Stan, thanks for coming on. I'm going to give you the whole time, so just fire away with what's going on and what you see, because not many people understand it.
Absolutely, Larry. The first chart we have here is the volatility index going back, about 10 years. And a couple of things I find are very instructive. When the VIX gets above 31, that has certainly marked a significant bottom over the last 10 years or so. And just about every single time that has happened, we've seen a major low. But there have been 4 times where the VIX has gotten up near the 50 range, which is an extraordinary level. Those 4 times, as one can see on the screen, occurred on August the 9th, 2011, August the 24th, 2015, February 9th, 2018, and most recently. And those points have marked extreme bottoms. Sometimes they have marked the exact low. Sometimes there's been a retest of those lows at some point in the future. But the point being is when the VIX has gotten this high over the last 10 years, as it did on Friday, that's been indicative of a significant low. Whether there's a retest out there looming, we don't know right now. We'll have to see how this thing develops. But certainly for the near term, I think we have a very important tradable bottom in the rearview mirror. Chart number 2.
You betcha. I'll get it up here in just a second here.
Okay.
There we go.
Chart number 2 is a weekly chart of the S&P 500 going back about 10 years. And what I've done is I've put 2 moving averages on this chart, one 50-week, the second is 200-week. And even with the pullback that we saw this past week, the S&P 500 is held essentially at the 50-week moving average. That 50-week moving average in blue is still pointed northbound and essentially has acted as support. So in the early part of February, we got quite extended above that 50-week moving average. We pulled back to just a little bit below it, but essentially it's acted as support. That average still has a positive slope to it, and my view is the secular bull market is still alive and well. We just killed off some of the extreme overbought condition, and we're poised to push higher.
Well, that was one of the questions that someone called in about, and you certainly answered that. It looks like we're over. Well, we've already seen the biggest up day we've ever had in stocks on Monday, and that's historical in its own. It's in its own right. That's for sure.
Well, that's a point worth mentioning. When I see a market sell-off, and then I see a strong turnaround, it is very important to see a very impulsive move on the rebound. For example, back in December 2018, off the low that occurred the day after Christmas, we saw a 4% rebound on December 26th, and that marked the exact low. And there was no retest, by the way. On Friday, we saw a low on February 28th, and of course yesterday, we saw a 5% rebound, which is astounding. That to me is very impulsive, and that just adds further credence to my view that a market low of importance has been seen.
Yeah, that's certainly historical. Now there's another chart. I think it's the one on the Dow Jones Industrial that I think the folks would like to see, and we'll get this up here. And then we have someone asked a question about bonds. Take care of this Dow stock, or Dow chart, if you could, for us, Stan. This is really interesting.
Absolutely, Larry. What we have here, about to come up here momentarily, is a chart of the Dow Jones Industrials going back a couple of years. And what I've done is I've marked several important bottoms on the Dow chart, beginning with the April 2nd, 2018 low. and then I mark the December 26, 2018 low. There it is. And then I mark the June 3rd, 2019 low. And I've done some detailed mathematical analysis and found that we have a very interesting 0.382, 0.618, 1.00 Fibonacci relationship, all clustered right on February 28th. And as you know from, because you see my newsletter and so forth, for the last several months, I've been targeting the end of February for what I thought would be an important bottom. And I have found just a plethora of Fibonacci and Lucas counts that all clustered right around the February. I thought that my clustering is right around February the 27th. And I thought we'd give or take a few days either side of that date, we'd see an important bottom.
Well, that's
and
certainly
so
been
far,
right on.
And last but not least, chart number 4. This goes into detail on a cycle you and I have discussed on the air many times. I found evidence of a dominant cycle in the markets that averages about 20 weeks. A detailed statistical analysis of the data says it's 95.5 trading days. And I've showed this cycle in my newsletter many, many times. And it was due to recur once again. I'm kind of slowing down here, waiting for it to come up on the screen. But my detailed regression modeling of the cycle said it was due to recur once again in the February 25th timeframe. And readers may have to magnify this a little bit. This is a page out of my most recent market report. But right at the bottom, you can see the regression modeling, and the due date that I had projected for this cycle was February the 25th, 2020. And the standard deviation on that analysis is 4.85 trading days. So what that said was this cycle, which last bottomed in early October of 2019. Prior to that, it bottomed on June the 3rd. Prior to that, it bottomed on December 26th and so forth. It was due to recur again in the February 25th timeframe with a standard deviation of about 4.85 trading days. And lo and behold, we got the low on Feb 28, right within one standard deviation. So, Larry, the sum total of evidence to me suggests that we have seen a market low of importance, and we're going to chug-lug higher. We're down a little bit here at the open, just a little over a Fibonacci 233 on the Dow. That doesn't bother me. I think we'll see a little pullback here. We'll gather some momentum, kill off the short-term overbought, and I think we're going to push higher, Larry.
Okay, thank you very much for joining us, Stan. We'll have you on again, and we appreciate it very, very much. Stan Harley of the Stan Harley Stock Market Letter. We'll be right back, folks.
If you're in the CD market and looking for a secure investment, the Tiger First Mortgage Program may work for you. The security for these first mortgages are building lots in the Tax Opportunity Zone in St. Petersburg, Florida. The Tax Act of 2018 set up tax-free zones across the country where you can build and hold for 10 years and pay no tax on the profits, which makes these lots valuable. The investment is anywhere from $30,000 to $75,000. The interest paid is 7% yearly, paid on a monthly basis. According to Bankrate.com, the best rate for a 4-year CD in the country as of February 20th is 3.1%. A $50,000 investment at a normal 4-year CD rate of 3.1% would give you income of $1,550 per year or $6,200 over the 4-year period. That same $50,000 investment in the Tiger First Mortgage Program would give you $3,500 per year or $14,000 over the 4 years. Which would you prefer, $6,200 or $14,000 of interest on your investment? If you would like more information about the Tiger First Mortgage Program, you can call me at 877-518-9190. That's 877-518-9190. The gold market has taken off topside in a large way in 2020. If you want to take advantage of this sector, now is the time to subscribe to my Gold Report. The Gold Report took profits in 4 of its equities in the gold portfolio in the first week of January for a combined profit of 99.2%, with 2 positions left in the portfolio that have a profit of 67.5% as of January 7th. The Gold Report is a comprehensive look at the metals sector as well as the markets that move gold, which is the currency and bond markets. New subscribers get a 30-day money-back guarantee, so you have nothing to lose. Every Monday morning, I publish the Gold Report with coverage of gold, silver, bonds, the XAU, HUI, GDX, as well as more than 30 different mining equities. To see for yourself the types of profitable trades that are recommended within the Gold Report, sign up now by visiting TFNN.com. Don't miss out on the next great gold trade. Sign up today.
Will the S&P 500 continue to climb? For bold trades on U.S. large-cap stocks in either direction, trade SPXL, SPUU, or SPXS. Directions Daily S&P 500 Bull and Bear Leveraged ETFs. Direction Leveraged ETFs. An investor should carefully consider a fund's investment objective, risks, charges, and expenses before investing. A fund's prospectus and summary prospectus contain this and other information about Direction shares. To obtain a fund's prospectus and summary prospectus, call 866-476-7523 or visit directioninvestments.com. A fund's prospectus and summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors. Distributor Foreside Fund Services, LLC.
The Bull Bear Trading Hour with Tom and Tommy O'Brien. Next.
Okay, we're back, folks, and I want to thank Stan and Rich for being our guests today. Tomorrow will be Bill Chapman, and also we will have Bill Meridian on Thursday. And Bill, as you know, is short bonds, short stock, and long gold. So we'll have him on. And what we're going to look at here, this U.S. dollar index, we posted here that there should be very, very strong support in the U.S. dollar index. The reason that we did this, folks, was because the dollar index is heavily influenced by the euro, which is 53%. And if you look at your euro chart, we were making a 78% retracement after the 10-day up move coming from that 107.80. And the Japanese yen was making a perfect 61% retracement also. We happened to be in that trade, and we did take our profits in that. Actually, went short and made a little bit of money too, so that worked out on both ends. But let's take a quick look at what that U.S. dollar did, and you'll be able to see the influence that it has as we hit these numbers. You'll get this up here so you can take a look at it. We'll see what's going. But we'll cover natural gas in just a second here, Bob, because there's so many things going on. I have really taken it off my plate, at least for the time being, because there's so many things happening, and it went below where I wanted it to go. So I'll wait and wait for another pattern. But look at this U.S. dollar index, how that key support held. Now, if we go below that, in other words, if the euro starts getting above that 112 area and the yen goes above the 93.5, boy, that would really tell us the U.S. dollar is weakening. That is really going to be a giant telltale sign of what's going on in the U.S. dollar, because if that happens, we are definitely going to weaken. Now, the bonds, we've had some really wild swings yesterday, $6,000, $7,000. We actually ended up being a $9,000 swing in the bonds. I haven't even had a chance this morning to check the open interest, and I'll do that at the break and to see what happened, because we had those huge open interest increases in the S&P, and if we didn't get an open interest increase in the S&P yesterday, we're going down. So let's just wait and see what that does. I'll do that at the break so that we'll, I don't want to do it right now because a couple other things that I really think I should cover just to be safe. You remember yesterday, folks, I talked to you about these key times that we look at for the AI program. I posted the one for what we're looking at this morning, and you'll notice here that key time was at 10:30. You notice how the market was coming down between 9:30 and 10:30. That gave it a really, really bullish bias. And then if you look at late in the afternoon, when the market was making a 382 retracement of the whole daily range, and the S&P rallied 100 points, and the Dow rallied well over 400 points to go from to make it 1,200 points, and then we went up higher higher yet. The 382 on the move on the S&P comes in at 30.75, but we made 3100. Now the key price to look at today is what we'll be watching when we are at roughly 10 o'clock. That's going to be the real key time from the way that we look at it. Now, whether that's going to be a high or low, we don't know, but the times are very sensitive, and if they happen to be making a high at that time, and if they do, pay attention to it, because if that's the case, that we could be looking at something that would be very interesting on the downside. Now, what you've got to do is you have to use patterns along with this, because you're only looking at time. It's not telling you what the price is. It's only telling you what the time is. So it would just give you a rough idea of what's going on. The gold market, we rallied very strongly off the bottom that we talked about. Silver's done the same thing. Platinum's done the same thing. All of those are in vogue to go higher until we take out those lows of last Friday. In fact, folks, you can take a marking pencil on your charts and just circle Friday, because if we go below those lows, I don't care what the news is, we're going down, because there were so many things happening on Friday that it was really when you startle the old cowboy, that pay attention to that, because you don't see it very often. That's the whole key. And what you hear about all this stuff means nothing, folks, because most of the time the people that are saying have no clue what they're talking about, or they're making it up as they go. So that's a really interesting thing to to keep in mind. Follow the little patterns, trade what you see, and you should be okay. I mean, it's not going to be the end of the world, but like OJ said, you might see it from the end of town. Let's take a quick look at what we're doing here in the markets. We got the S&P trading at 30.70, a low close today, folks. All we saw was the key now is, do we go below Friday's low? And if we do go below Friday's low, the cat's going to be out of the bag, and that's going to be telling you a huge thing. In other words, this was nothing more than a 3-day rally going up to either the 38% or the 50% retracement. However, if we're really strong today and we can get up in that area of above 31.15 or something like that, then you've got a real chance to see if that's going to be the case. And that's really what you're watching is as you're looking at some of these things, because what happened on Friday was extremely unusual, folks. I didn't spend 20 hours over the weekend writing that report, to give you some information. I didn't think, and it's just technical information. It has nothing to do with news. It's just whether there was more buyers or sellers coming in at that time. That's really all it was that you were listening to. So let's remember that it's quite important for sure. That's the main thing as we want to watch these things as they unfold. The crude oil, folks, we had a very interesting pattern in crude oil last night. Those of you that follow the ABCDs in crude, you won't have to like defy human nature, do the work yourself. You'll see that we had a perfect ABCD pattern in the crude oil coming in at that 58.60, I believe, 48.60 level, and that's what we're watching. I think we have a caller coming in. Okay, Mr. Z is saying they're bottoming in the cattle. Yes, I believe that we hit some type of a bottom in everything on Friday. And I don't know what the key word there is, everything, but by golly, something really happened. We even had a big move in soybeans. The only one that hasn't moved was wheat. So we're keeping a close eye on the wheat. Like Rich mentioned, the trough, I don't have the crude oil chart in front of me. I've tried to get it, but it's just too many things happening at once. But I do have it from Friday, and I will bring that up for you right now. Just give me 1 second, and here it'll come very, very quickly here. You'll be able to see that we were watching for this bottom possibly in the crude oil, and you'll see here that was the weekly 61% retracement. We went down, we matched last week's low by just a little bit, took it out by about a few pips and rallied $5 a barrel. And that $5 a barrel, folks, here's where you have to do the work yourself. Go look at a half-hour chart, and you'll see a perfect ABCD pattern at the high at that 48.60 per barrel level. We went from, it was almost $6 rally from the bottom. So That's a very, very important ABCD. If we start getting above $49 a barrel, folks, that's going to mean game on, because you're breaking all the major resistance areas, and that crude oil. Hey, we were at 65 back in September. We could easily get back to that area. The way these markets are running, hello, son of a gun, they really have heck of a runs. Watch it. Okay, the key to the markets is watch the U.S. dollar. We've said that. If the U.S. dollar starts to fade, we're going to see some inflation start to come into these possibly, and we'll watch it closely. And watch the bonds. 877-927-6648. We'll be right back with open interest.
I'm certain you are or strive to be one of the best at everything you do in life. It's the most common trait that we tigers and tigresses share. If you're looking to become the best of the best when it comes to managing your money, let me teach you to do what most wealth managers tell you can't be done, which is how to time the markets. I'm Steve Rhodes, author of Mastering Probability, and for the last 12 months, Timer Digest has been tracking my newsletter signals, which have earned me the ranking as their #1 market timer in the nation for the S&P 500 for the last 12, 6, and 3 months. Timer Digest also ranks me as the #1 market timer for gold as well. The fact is, markets can be timed, and I'll teach you the exact set of tools that I use that has transformed me into one of the best at what I do. Sign up for Mastering Probability today by clicking on the newsletter tab on the homepage of TFNN.com and get immediate access to workshops where I take you step by step how to use an extraordinary set of tools, as well as provide great market calls too. Sign up today.
If you haven't checked out the newsletters page of TFNN.com, what are you waiting for? All of the TFNN newsletters are informative, up-to-date, affordable, and a must-have for every trader looking to gain a competitive informational edge in today's markets. TFNN newsletters cover every aspect of the markets to offer you the very latest in market news. Plus, new subscribers get to test drive our newsletters risk-free for 30 days. From all aspects of the markets, including stocks, bonds, metals, commodities, and tech, there's a newsletter to fit your needs exclusively from TFNN. Stay informed each day you trade and get that competitive edge that will help you stay ahead of the game. Visit our newsletters page by going to TFNN.com and click the newsletters button near the top of the page. TFNN.com, educating investors.
Since 1984, Basil Chapman has been using the Chapman Wave methodology to advise traders of his expert market opinion. While originally hand-drawing charts from the late 1970s into the 1980s, Basil noticed that prices under most circumstances virtually always had a certain number of legs to the upside before declining sharply. Later, Basil found that computer software, which included the standard market technical indicators, enhanced the degree of accuracy in calling price turns as well as market trend calls. Thus was born the Chapman Wave sequence. Using the Chapman Wave methodology along with other indicators, Basil Chapman advises his subscribers of his expert market opinion each market day with his opening call newsletter. Right now, you can get a 2-week free trial to the opening call, Basil's daily trading newsletter, by visiting the front page of TFNN.com. Cancel at any time during that trial and pay absolutely nothing. Get your 2-week free trial to Basil's newsletter, The Opening Call, today by visiting TFNN.com.
This segment is brought to you by Think or Swim. For more information, just click the Think or Swim banner on the front page of TFNN.com.
Okay, folks, I'm going to post the open interest for the Treasury notes, the 10-year and the 30-year bonds where open interest dropped also. And also I'm going to post the one for the E-mini S&P with that big move up yesterday, folks. Open interest dropped. That's not bullish. And we've got Robert from Kansas on the line. Robert, what can I help you with?
Well, it just so happens I have a question about open interest on the Treasury bonds. So,
go ahead.
I go into the CMEgroup.com website, and then I go to data, and I go to open interest. and there's a section that kind of gives it for interest, metals, FX, equities, and so I go into interest rates, but I'm not seeing the 30-year Treasury, and I just didn't know how you got there or how found the open interest on the 30-year Treasury. They have the 10-year T-notes, but I couldn't find the 30-year Treasury.
Okay, 30-year Treasury is under U.S. It'll say U.S. Treasury bonds. It's towards the bottom of that same chart that you're looking at. I just posted into the room today. But if you go towards the bottom of the page, it'll say U.S. Treasury bonds. It'll have all kinds of options, things. But you want to look at the futures. The open interest is running at around 650,000. The open interest on the notes is roughly 3 million. I just posted that one. The 10-year note is the one I watch the most because that's the one for credit cards, automobiles, consumer loans, that type of thing, mortgages. So that's the really large open interest, and that dropped yesterday, and that's been dropping. So that's telling you that people are not interested in being long those notes and bonds. At least they thought most of it's over. So that's what we're looking at, Robert. I hope that helps. If you can't find it, drop me an email. What I'll do is I'll make you a little video to show you how to do it. But you're on the right path. You just didn't go down the page far enough to look at. You probably looked for a T for Treasury bonds, and what they do is they mark it as U.S. Treasury bonds because they have corporate bonds in there too. And I don't have an interest in those. So if you'll go down farther down the page, it's about 3/4 of the way down the page, you'll see that, Robert, what's really funny is when I started trading commodities, we had about 25 things and no options. And now there's 250,000 things that you can trade. So I can understand where you might lose something. But look under U.S. Treasury bonds and you'll be able to find it real easily, I'm sure.
Okay, thank you so much.
Hey, thanks for calling in. We really appreciate it. Live every day in an attitude of gratitude, and may God bless, and we'll see you on the flip side.